Hello. Are we alone in the universe? No. Alone. Hello, Jim. You hear me loud and clear?
Yes, loud and clear.
Okay, it's noon, and I'm really glad that we actually have quite a few people already here, and because of that, I want to kick things off. It's not very characteristic that Malaysians are on time. So this is great, which tells you that people are interested in the topic. To all my Muslim friends, um, selamat berpuasa. There's only a few more days. And maybe if you were dialing in earlier, you could see that we have this Raya promo going on. So in in the spirit of the festivities and investing, do take advantage of that, and we'll cover that promo as well. So today we'll talk about a few things. We'll talk about, the basis of Bitcoin. What is it? What are the fundamentals behind it, if there are any? Yeah. We'll talk about the investment case, why it should deserve a spot in your portfolio if you're so inclined. And then we'll talk about some recent political developments that have been uh, really, really um, prevalent, I would say. And then we'll close off with how exactly you can access the ETF, these ETFs on the StashAway platform. So again, good afternoon. And my name is Ken. I'm the country manager of Malaysia. Um, and I have Jim joining me from Hong Kong. Jim's in our investments team, but I'll let him do a quick introduction of himself as well. Jim?
Sure. Hi, everyone. My name is Jim Tai. I'm the head of quantitative research and portfolio management here at StashAway. Just a little bit about me. I have degrees in applied mathematics and electrical engineering from Princeton and Columbia University. And in terms of work experience, nearly 2 decades in the investment industry, spanning roles at Merrill Lynch and also family offices across New York and Hong Kong. So
Mm.
looking forward to having an engaging conversation about Bitcoin investing with Ken and how it might fit into your portfolio.
Amazing. And if you have any comments or questions, do drop them in the chat or the Q&A box. If you have them, then we'll visit them at the end. So let's move on with the first um, topic of discussion today, right? I think everyone has heard of Bitcoin at this point, and whether you are someone who has been a skeptic or you're crypto curious, maybe you're on the fence, or maybe you're a crypto expert already. You've been through a few cycles, you've made some money, you've lost some money, whatever it may be, you've definitely heard of Bitcoin. And I think one of the larger um, points against crypto or Bitcoin in general, or what skeptics have in mind, is that it's not a real asset class. Unlike gold, which has industrial users, it's something I can win at the Olympics. It's something I can own. It's very shiny. It's very nice jewelry. But Bitcoin is truly, truly digital, right? So because of that, it may quote unquote lack fundamentals. So maybe Jim, let's kick things off with, in your view, or at least with StashAway's view, what are the fundamentals or what's real about Bitcoin?
Yeah, I mean, I'm glad you raised that question because I feel like when people talk about Bitcoin not being tangible, they tend to
Mm,
think about it in terms of traditional asset classes like real estate or like companies that produce goods. But I think it's worth thinking about Bitcoin sort of in two ways, perhaps. The first is the infrastructure that it sits on. And the second is the rewards that are distributed to miners and what people normally think of when they think of Bitcoin, which is digital gold. But if we first think about Bitcoin being tangible from the perspective of the underlying infrastructure, the Bitcoin network is built on real computing infrastructure, like there's real servers there. The maintenance, the progression relies on real computer code, the ledger anyone can inspect. The ledger itself has complete unchangeable history of every transaction that's ever been made. And then there's also miners who verify these transactions. There's real energy that's being consumed. And, like it's quite similar to the modern banking system, except that the modern banking system is a lot more opaque, a lot more inefficient, given that there's not a single consolidated ledger that exists. So that's more so on the infrastructure side that makes Bitcoin tangible. But I suppose when people think about Bitcoin, they think about the actual coins itself. And from the second perspective, perhaps it's useful to think about it by comparing against a related asset class like gold. And so, with good reason, people argue that Bitcoin is like digital gold in some of the comparisons are that, number one, it's seen as a store of value outside of traditional banking systems. There's a limited supply cap. So for Bitcoin, there's a 21 million finite supply. And for gold, there's obviously a finite amount of gold that can be mined on Earth. There's also value that's derived from collective agreement and trust rather than necessarily real industrial utility. Both also function to various degrees as inflation hedges against fiat currency devaluations, with Bitcoin currently being a little bit more aspirational in this nature than gold. But more importantly, they also both serve as financial alternatives during banking crises and instability. So from this perspective, I feel like the value proposition, the fundamentals of Bitcoin are quite similar to physical gold. And I think if you want to draw some, a metaphor or parallels, the Bitcoin is a little bit like the internet. It's not physically tangible and you can't physically touch it, but you can interact with it in very physical ways, and its effects in the world are very real and measurable.
Yeah, all good points there. When you mentioned, specifically that it's not a real world asset, I also thought of the fact that real world assets have downsides as well, right? Like real estate is never truly comparable. New York real estate, Hong Kong real estate, Sydney real estate, they're all like in different places physically, and then they undergo wear and tear, and there's like climate change and erosion and things like that. And then in terms of the capital markets, obviously there's friction as well, right? Like there's taxes, there's information inequality, things like that. So I think as humans, we have a bias towards like things we can touch and feel, but like you said, like the internet, it's very real, even though it's in ones and zeros, right? So just to cover some basics here, I think we all know that a big value proposition of Bitcoin is that it does not inflate. It has a 21 million supply cap. It's also very diversely held by a lot of users. There's a real grassroots kind of support and belief, which is important in any kind of asset gaining momentum. And as we'll talk about, institutions are coming as well. I found it interesting that it does consume quite a lot of energy, 20 gigs at any one point in time, right? And then I benchmarked it against some smaller countries, and this amount of energy is more than what Malaysia like consumes at any one point in time. So it's a lot. And obviously market value is one sign of legitimacy. Obviously it's volatile, but like at this point it's around 1.7 trillion. So moving on, I think it's really important to highlight two trends in the sense that supports the fact that the crypto market is maturing. I think in the early days, there's this image that crypto and Bitcoin is for those who are like live on the internet, all these people who are like living in their mom or dad's basement, it's magic internet money. But it's very much encroaching into the real world. And the first big trend here is ETFs. Jim, what are your thoughts around this really big momentous occasion and milestone for crypto?
Yeah, I mean, I think it's absolutely amazing sort of what we've seen in the ETF space in terms of adoption. I mean, I think before we sort of talk about sort of the AUM growth in the ETF space, it's worth noting that even leading up to the creation of these ETFs, they also needed regulatory approval, right? And so the fact that you're able to get that through and also then see this sort of inflow coming into this space, I think it's a really good sign for this particular part of the industry as a whole. But I think more importantly, I think one thing that I would sort of think about when we look at these numbers, and they're quite big, right, is that it shows that there's mainstream acceptance, right? Like you said, it used to be that like crypto was on the fringes of finance. It used to be like something that was a little bit more esoteric. But I think the fact that now that you're seeing all this inflow coming in, also not just from retail investors, but really from institutional investors, I think that really shows that the adoption here is really picking up. And so it's really a combination of the mainstream acceptance, but also the institutional validation that there's credibility behind these cryptocurrencies. And so I think it's a phenomenal sign for the market itself.
Exactly, and then more ETFs potentially along the way. And I think it's really, I don't know if ironic is the word, but it's truly momentous when a digital asset is wrapped by traditional finance and then offered to investors who traditionally have not been part of the rise of crypto. Speaking about institutions, I also wanted to touch on this big trend, right? That there's increasingly institutional interest, not just from the funds buying into crypto as an asset class, but there's also like banks who see this as a real money-making opportunity to offer this crypto to their clients. Talk about exchanges, talk about private banks, that kind of thing. And then there's also real companies building on top of the blockchain. Right? And when we talk about crypto adoption, it's not just about price going up, right? It's about expanding the crypto ecosystem, and part of that is advancing adoption of the blockchain or advancing activity on the decentralized world. Jim, anything to add in terms of the role institutions have to play and the kind of trends, interesting case studies you've seen?
Well, I think,
institutions.
yeah, I mean, I think it's actually, I mean, this for this particular slide in general, I mean, I think it's worth noting a few things. So on the sort of aspect of financial institutions, I mean, on the government level, we can talk about the US side of things sort of later, but El Salvador adopted Bitcoin as legal tender not too long ago. And so I think that was a pretty momentous shift for the cryptocurrency universe. On the pension fund side, you also start to see like very large public pension funds start to dive into the space as well. So I think more notably, the Ontario Teachers Pension Plan has invested in Bitcoin to some degree. And also, I believe the Houston Firefighters Relief and Retirement Fund also has direct investments in Bitcoin. And that's all sort of signs that you probably, I mean, you wouldn't have seen this 5 to 10 years ago, right? When this asset class was just emerging. And as for listed companies, we've seen, MicroStrategy, well, what was formerly known as MicroStrategy, now known as Strategy, hold Bitcoin. But also, I mean, that's sort of more speculative, but also you have companies like Tesla who also hold Bitcoin on their corporate balance sheet, right? And so I think that gives it some legitimacy in terms of being like a sort of reserve sort of asset that can be, that can retain value, right, as a store of value.
I think it's also worth noting, to balance out the conversation, there are institutions who are skeptical, right? There are institutions who are also still waiting and seeing. I think more notable ones include Singapore's Temasek, right? They have made some big investments into crypto firms. And then, because of FTX and maybe some other non-performing assets, have decided to be more cautious. I think closer to home, Ben Negara recently also made some media comments around the fact that when they're not ready for Bitcoin to be part of like their treasury or something we should stockpile. But I think the point is that these early movers are the tip of the spear, and then depending on adoption trends, more might join as well. So we're really looking at green shoots here. We're not saying it's a very mainstream, but I think relatively speaking, we're all early here. Here are a few quotes by some notable people that I might add at some point were also skeptics. I think Stephanie, our CIO, is a little bit more progressive, right? She's a new age kind of CIO, and her point of view is, that if the institutions do look at Bitcoin in a serious way and allocate even 1%, we're talking about at least 1.5 trillion coming into the space, and right now Bitcoin is around 1.7 trillion market cap. So you could see a doubling of that market cap if institutions look seriously at this. And funnily enough, Bitcoin, BlackRock itself mentioned that obviously they're behind the ETF, the largest Bitcoin ETF, but they themselves have added 1% into their model portfolios. Kathy Wood, I think, has always been early. She's very progressive. I think she's on the right side of tech adoption here. And then Goldman Sachs, I think, from a trading perspective, has seen Bitcoin to be also very, very interesting. Jamie Dimon's not here. He's supportive of blockchain, but he still has a negative view on crypto, in that it might be used for money laundering purposes. So I've put up some very positive things here, but there are also some skeptics. Moving on to how crypto kind of affects your portfolio, I think this is the real meat of the conversation, right? Let me kick things off by stating the obvious. That's why I'm here. That's why they pay me the big bucks, to say the obvious, right? But like, I've held Bitcoin since or crypto since 2021, and I can tell you that you know it's volatile, but until you invest, you won't really know what it's like. because it's not like any other asset class, but if you've ever owned, it does have a, a real emotional impact on you, right? Because if you are so tied into checking the price every second, it's a 24/7 trading asset class, you might get addicted to looking at your screen. You might get very anxious in the middle of the night. You might get hooked on looking at Twitter nonstop. So I just wanted to tell you guys that like the effects are very real, especially the emotional ones. And then we'll dive into volatility and Sharpe ratios and things like that next. So Jim, please walk us through what are the benefits or the effects that a limited exposure would have, and why are we keeping it to such a limited asset allocation?
Yeah, sure. I think perhaps before I talk about what Bitcoin looks like when you sort of put it into your traditional 60/40 portfolio, it's probably worth noting just to look at Bitcoin itself. And so on the previous chart that Ken had shown, you did see sort of a lot of these boom and busts in Bitcoin over the past decade or so. And so I feel like this is the sort of this sort of volatility is quite common in the cryptocurrency space. And it's really not for the faint of heart, because if you look at the volatility of Bitcoin on an annualized basis, it comes out to roughly kind of call it on the ballpark of 60% annualized volatility. To give that number some context, the US equities like annualized volatility is somewhere in the ballpark of 10%. So dollar for dollar, it's
could you say that again, Jim? I thought it was really interesting.
Yeah, so the annualized volatility of Bitcoin is roughly 60%. The annualized volatility of US equities is roughly 10%. And so dollar for dollar, the volatility is 6 times higher by holding $1 Bitcoin versus $1 of US equities, right? And so if you thought US equities was already quite risky or quite volatile, I mean, this is 6 times more, right? So it really is sort of not for the faint of heart, assuming that you're holding 100% portfolio of Bitcoin, which I don't necessarily recommend unless you really do have that risk-taking spirit and you're willing to hold, or hodl in crypto terms. But I think what you can control really is sort of the sizing part of it, right? So, and that this is sort of how it ties back to how it looks in your portfolio, because in spite of the fact that the volatility is so high and the drawdowns are so severe. So for example, like in the history of the past 10 years or so, the maximum drawdown for Bitcoin was roughly 83%. I think that number is not one that many people can stomach, right? But if you can size it appropriately in your portfolio, actually, it has a lot of amazing diversification benefits. And so if you look at the 60/40 base portfolio, so this is 60% equities, 40% fixed income, on average, you're talking about a 7% annualized return on a 9% vol, which gets you to roughly a 0.7576 Sharpe ratio. But by just including 1% of allocation to Bitcoin, you get an extra 50 basis points, or 0.5% of annualized returns, and a bump up of 0.05 to Sharpe, without really impacting the volatility, the amount of risk that you're taking. And then if you bump up your allocation to Bitcoin to 5%, then all of a sudden your annualized return, you get a pickup of roughly 2.5% increase of Sharpe by 0.23. And again, like the amount of risk that you're taking, the amount of vol that you're adding to your portfolio is only 0.3%. So basically the story here is that the amount of risk that you're taking by adding just a tiny bit of Bitcoin really improves the overall performance of your portfolio, not just from a return basis, but from a Sharpe basis too. And I think this is the whole point of, I hope this is the takeaway that people will have from our conversation today, which is that from a diversification standpoint, I think having Bitcoin or cryptocurrencies in general, if you can size it correctly, is a really integral part of asset allocation.
And let's say, Jim, for argument's sake, right? Let's say someone allocates 5% to Bitcoin and it goes on a really good run and it goes up to, say, 10% of the overall portfolio. What should people do? Should people size down, or should people just leave it and hope for the best?
I think the recommendation, well, there's two components to this. I think one, you can if you're really feeling passionate about Bitcoin, you really are bullish about where it could go, and you wanted to pick up a little bit of extra returns, assuming that you're right, then like you can make the argument that you should just continue to hold and let your allocation grow. But I think the prudent thing to do is to always sort of rebalance back to some sort of target. So if your allocation is 1, 3, 5% to Bitcoin, and because of how much Bitcoin has grown, let's say it's doubled in size, so your original allocation of 5% went up to 10%, I would actually advise that you actually scale back down to 5%, because the amount of incremental risk that you're taking by letting Bitcoin be such a dominant part of your portfolio might end up becoming detrimental in terms of the amount of volatility that you're taking and the amount of risk that you might be able to take, right?
Yeah, exactly. And then, not all portfolios are the same, right? Or investment portfolios, because there's different sizes. Let's say if you're talking about a $10,000 position becoming $20,000 position, then it's like, okay, it's a nice chunk of change. But if your investment portfolio is $1 million and 10% is 100K, assuming, let's say you're in your late 30s or late 40s, that can go a long way, right? And you might want to take some risk off the table for some of the very real medium and long-term needs that you and your family might have. So, if you're a teenager and then like 5,000 becomes 10,000, great, right? You're gonna have an amazing holiday, an amazing night out. But like, you need to think about your own needs, and the size of portfolio also plays a role, right? So
absolutely.
And Jim mentioned incremental risk, right? So let's talk about that, right? I think when you think about sizing in terms of allocation, why is 5% kind of the line we draw in the sand? If let's say someone brings it up to 10%, is that ultimately so detrimental to your portfolio?
Yeah, I mean, so I think when it comes to risk, it's always a very personal question that you have to really be honest with yourself. And I think the reason why we suggest limiting your Bitcoin allocation to 5% is that as a percentage of the risk that you're taking in your portfolio, it really does end up becoming more and more exponential as you increase the linear amount of allocation that you're taking, right? And so in this chart, you can see like at a 5% allocation, just a 5% allocation to Bitcoin, that would already account for roughly 20% of risk in your portfolio. But if you, let's say, size that to 25% of your portfolio, the amount of risk that's contributing to your portfolio risk is roughly 80%. And so
yeah,
I would argue like that's probably more than most people can handle, which is why you should really only limit it to sort of in that ballpark of 1 to 5%.
A little bit does go a long way, right? Last thing you
Yeah.
want is to have all your risk come from one asset class. And we all know how volatile Bitcoin is.
Right.
Moving on to so this slide here, I think crypto has this connotation of getting people rich very quickly. It might be seen as or optimized for a short-term trading tool because it's so volatile. There's definitely merits to those views, but having your team run these numbers, what do you think of Bitcoin, or in this case as well, Ethereum, being one of the longer-term holdings in anyone's portfolio?
Yeah, I mean, I think so. This chart kind of just is a good way to visualize where crypto, specifically Ethereum and Bitcoin, kind of stand in the context of asset allocation. And I think when we take a step back and we kind of think about the traditional sort of asset classes or the space that we can invest in, there's only really a few, that we can sort of identify. One is equities, right? That's sort of, everyone knows like stocks and stuff. And then you have fixed income. So that's sort of where the bonds sit. And you have commodities, which kind of is like the real component of like investing. So like gold and real, like you can sort of categorize real estate under that sort of broad category. But I think, with the emergence of Bitcoin and Ethereum, I think you could argue that crypto itself is its own new asset class. And that's quite powerful because that basically gives you more tools to play with when we're thinking about portfolio diversification. But importantly, I mean, we'll see later, there's correlation benefits that you get, which help with that, the diversification there too. And so if you look at this chart, basically you'll see that actually over the past 5 years, now also over the past 10 years, the Sharpe of Ethereum and Bitcoin actually haven't been detrimentally worse than like other things like NASDAQ, gold, S&P, even though, I'm sure people have seen like all the news about the volatility around Bitcoin, ETH, and, all these collapses, sort of all the things that we've seen over the past decade, starting from Mt. Gox, then to FTX, all, then like Lunaterra, all this stuff. But in spite of all of that, we still actually have a very solid Sharpe ratio for Ethereum and Bitcoin.
Yeah, and Bybit more recently as well, right? That
Exactly.
was a very, very big hack.
Yeah.
And you've thrown some colorful spaghetti on the wall and produced this very lovely modern art piece. But no, the jokes aside, I think you wanted to make a point about diversification here and how correlation, or the lack of correlation does help you.
Exactly. And I feel like, if we think about portfolio diversification and portfolio allocation, really it comes down to thinking about how to put the building blocks in your portfolio together. And ideally, I think, when you're trying to build out a diversified portfolio, what you really want to hope for is that each additional building block that you put into your portfolio has either zero correlation or some amount of negative correlation, right? And so the latter is the reason why a traditional 60-40 portfolio has worked so well. It's because in general, when equities go up, bonds tend to go down and vice versa. And so that's sort of each of those sort of building blocks helps to buffer the other when one is underperforming. And gold being its sort of own independent sort of asset class, or like commodities in general, but I'd say specifically in this case, gold, it has an important piece in the portfolio as well. And that's kind of why in our general investing portfolios, we started to add gold into our portfolio as well, because it adds a sort of another dimension, another axis that allows for further diversification, because it has its own sort of macro drivers that moves separately from traditional equities and bonds. But finally, you have Bitcoin now, which also is moderately correlated, positively correlated with equities. So obviously during equity bull cycles, crypto will also rally in kind, but that correlation isn't super strong, which is great, because what you want is to have these things to move more or less independently of each other while still maintaining a positive expected return. And so, the point of this particular chart isn't necessarily to scrutinize how these correlations move over time, but it's more just to emphasize, if you just look at this, to show that like it means the Bitcoin moves independently of sort of other asset classes, which is really important when it comes down to diversification.
Okay. One really big thing that has emerged since the Trump election, and I think has, for some surprised on the upside, but for others, I guess it's like they've delivered on their election promises, is really how the US has pivoted to becoming very pro crypto. I think this is it's a big function of the administration and how they view crypto. But just to go through some of the recent regulatory trends, specifically in the US, I think the first thing is that President Trump, who he himself describes himself as a crypto president or Bitcoin president, is key appointments, right? The right people in the right positions to not just be a benign force, but actually be pro crypto and move it along. Obviously, with a US first agenda. I think in the previous administration, there was people who were big skeptics and even had negative kind of policies around how they treat crypto. So if you look at key appointments like Percent at Treasury, Howard Lutnick at Commerce, or David Sachs as the crypto czar, I think these are big figures that have a foot in the crypto space or the tech space, and definitely will be more friendly from a policy standpoint going forward. And if you talk about regulation, there's a high level kind of executive orders, which I guess are just directional, but then there are very specific things like accounting standards, and also from the SEC pulling back the cases against big crypto firms like Coinbase or Robinhood. So in the last really big one here being the strategic Bitcoin reserve or the digital asset stockpile, which formalize the holdings of the US. Jim, I want to bring you in here. Which of these trends have you seen as being the most material to crypto?
It's hard to identify a single one because I think all of these are quite material to the development here. I think there's a lot of anticipation for the SBR, or the Strategic Bitcoin Reserve, when it was first announced prior to the executive order. But I think once we saw the details about what that might look like, I think there was some amount of disappointment because I think there was speculation that as part of the reserve, the U.S. government will also hold altcoins like Ripple, Solana, Cardano outside of just Bitcoin, including ETH, right? But it seems like not only is the U.S. government not going to acquire at its own dime additional Bitcoin, but the Bitcoin will be the Bitcoin that goes into the reserve will be forfeited from the forfeiture of existing Bitcoin that the government already holds. And so I think that part is still sort of remains to be seen, like sort of where it can sort of stand. But in terms of key appointments in pro-crypto regulation, for sure, those are all huge things that didn't exist under the previous administration, but also are very, very positive for the crypto industry as a whole going forward.
Yeah, I think specifically to the Bitcoin reserve, I think holders of Bitcoin would have expected more of a rally because maybe in the best case scenario in their minds, they thought that this would kick off some sort of arms race from nations kind of piling in, right? Obviously, that didn't happen. There was a small pop when President Trump announced it on Truth Social, and then when it became official at the crypto summit at the White House, then by then it had fizzled, right? So when more details have emerged, it just seems that the US is taking a very measured and gradual approach towards setting up and putting this SBR into effect. And one thing worth noting is that they want it to be budget neutral. They're very, very aware of looming debt. The US debt is ballooning, and part of Trump's mandate is really to bring that down, hence Doge and things like that. But I think there might be things in the pipeline that could add to US buying, right? Like Senator Loomis's Bitcoin Act, which talk about actually acquiring a certain amount of Bitcoin over a 5-year period. But that's still very early, right? So democracies take time. There's a process to go through it. I'm sure everyone's kind of debating things, considering the political and economic realities that the US is in now. One talking head on the TV or YouTube was like, from one of the reputable fund houses was saying that it's a political calculus, right? When you have inflation and high interest rates, you can't justify to the American people that you're going to go on this Bitcoin buying spree, some of which might be skeptics of Bitcoin itself, right? Because what are the benefits to me as a person on the street when milk and eggs and gas are still at elevated prices? So I think, that gives you a bit of context as to why it's still around that 80K, 90K mark, and it hasn't kind of flown, but I think it will be gradual and these things will take time. Okay.
Actually, one additional thing I would probably add here is also that, even though this, the news of the SBR and also a lot of the regulations that's come out recently, even though it hasn't really been supportive of Bitcoin or ETH prices, there has been sort of it seems like there's a legislative priority to look at stable coins. And I think this is kind of an interesting part because I think the US government probably is more incentivized to think about stable coins because it's a little bit, in its word, in the term itself, it's stable, right? Because each digital stable coin is convertible to a US dollar. And it's also becoming like these stable coins are increasingly becoming larger holders of like US Treasury assets.
Yeah.
And so I think it becomes easier for the government to probably talk about regulations from stable coins that could actually transform how finance plays out in the US going forward. But I think once you also have sort of stability in stablecoin regulation, that also will be very, very beneficial to the development of Bitcoin and ETH going forward too. Because I think everything will compound on top of each other here.
Yeah, the real world is being digitized or tokenized, and we're talking about treasuries as well, and like you said, dollars. So yes, I think this points towards more US-centric mainstream blockchain adoption. Okay, coming back a little bit more closer to home, and Jim, chime in if you see the need. I think if you look at what we're offering a very straightforward way to get exposure to Bitcoin and Ethereum. Don't need to learn how to use wallets, cold wallets, hot wallets, or things like these physical trezors over here or ledgers over here. I think operating on an exchange does have some benefits. I'll talk about some of the cons later on as well. And then we've chosen ETFs who have issuers that are very legitimate and ultimately have good underlying liquidity, very low fees, good tracking error, and all of that. I think worth highlighting as well is some of the cons. Because it's through an ETF, it operates on normal exchange hours. So on the weekend, if you're feeling a little bit anxious about selling your Bitcoin, you can't. Or if you're feeling very excited because, let's say, there's moves over the weekend, you can't as well. But on the flip side to that, coming back to how that's a positive, I think it helps with a little bit of impulse control. You can't exactly get 24 hours, 7 days a week kind of trading. And anyway, StashAway is not optimized for that. So how you can best get exposure long term, I think, is to DCA, to dollar cost average, into these ETFs which we offer, and have a long term view on things similar to the rest of the asset classes and portfolios that we offer as well. We are not optimized for minute by minute, second by second trading. So I think if you're really a hardcore trader, you should think about using different services. These are the ETFs which we have chosen. Both happen to be issued by Fidelity. One is the Fidelity Wise Origin Bitcoin Fund. The other one's the Fidelity Ethereum Fund. Both have good size, liquidity, have low fees, and have relatively narrow spreads as well. Jim, anything to add in terms of the selection criteria for these ETFs?
No, I think you covered most of it. I think really when we're looking at how to sort of add or which crypto ETFs to add to the platform, it really came down to liquidity and it came down to cost, right? And so sort of one of the fundamental principles at StashAway is that we want to make sure that we minimize as much as possible on the cost side so that we can deliver more returns back to the users. And so I think at a 0.25% expense ratio for both these ETFs, I think that's a sort of reasonable cost to take, given that that's going towards like custody of the actual physical assets and that kind of stuff. But also, more importantly, on the trading side of things, liquidity obviously being very important. The liquidity for these two ETFs, for both the Bitcoin and the Ethereum funds, they're all very, very liquid. And so we won't sort of be seeing too much in terms of like the transaction spreads.
Yeah. And already in the Q&A, there's some very good questions around custody. So I think on this page, I will address those as well. We'll start first with the issuer. I think we all know Fidelity. It's a household name. Issues quite a few ETFs. Not sure exactly how many, but probably quite a lot. And I think this severely reduces counterparty risk. We're not talking about a new and emerging player here. So from a business model standpoint, I think it will withstand any kind of crisis. And then when it comes to how it actually custodizes the Bitcoin that backs the actual ETF itself, it uses Fidelity Digital Asset Custodian. So it's a sister company that has custodian services. Fidelity has been dabbling in Bitcoin for I think pre-COVID even. So it has experiences dealing with these cryptos. I think they've also offered it to customers. They've also customized it for customers. So they have selected kind of a almost in-house custodian option. Some of the other bigger ETFs have chosen Coinbase as a custodian, and Coinbase is obviously a very reputable name as well. It is third party, so there's a little bit more links in the chain, but that is just a different setup to what Fidelity has. So Fidelity, just to recap, Fidelity, the issuer, appointed the FDA, which is Fidelity Digital Assets, as its custodian, and they have a lot of experience dealing with these things. And some of you talked about hacking risk. I think that's very valid, and it tells me that you, as the investor today, is concerned about these things, and rightfully so, right? There are big hacks that have happened on reputable exchanges as well. And we asked the same questions to Fidelity Digital Asset, the custodian, and the issuer. And essentially, they talked about the fact that Bybit has a very different set of operations because it's an exchange. And because, Fidelity is a ETF issuer, it is a different kind of setup. We won't comment on what is safer. They're both kind of very different animals, right? So as an exchange and as an ETF issuer, you have a different operational setup. So we also asked about insurance policies and things like that. And the FDA does have a group insurance in place for claims over 100 million. Obviously, as a fund manager who has selected Fidelity, we also ask some of these extra questions. So yes, I think we are assured of the answers that they've given us so far to how they store the coins, the insurance that is in place, and the combination of hot and cold wallets that they use to make sure this is all safe. Another person asked over here that the MAS in Singapore in Parliament have raised that consumers should steer clear because it's volatile, it's speculative, and it lacks fundamental value. So I think that's MAS's view. To my knowledge, BNM has not come out against cryptocurrencies. Maybe they've come out against certain scams, and people should be careful of those things. But that's two things, right? So to address that concern from the MAS, I think MAS is trying to protect its investors, trying to protect the retail client base, and that's one policy stance you could take. It is volatile, yes. Parts of crypto are very speculative, especially those like meme coins that are traded as well, and certainly lack fundamental values. But I hope that you can see from our discussion today that the cryptocurrencies we have chosen have some fundamental value and have some investment merit. We're not endorsing all coins or meme coins, things like that, and just saying that all of crypto space is created equal. We're picking two of the largest cryptocurrencies there are out there, and they are offered through ETFs, which is a very mainstream way of getting access to asset classes. So, and we spend a lot of time talking about the investment benefits as well. So I think it does address some of your concerns if you do have that. If you're not convinced, right, and if you do take guidance from the MAS and you do want that kind of oversight and from your regulator, don't invest in cryptocurrencies, right? There's a significant chance of losing your investments, your value, the principal that you have put in, and you should steer clear, because ultimately, if you can't handle the risk, you won't be a great crypto investor, because the volatility will ultimately just shake you out. So I would say steer clear if you're truly uncomfortable. If you do have a small inclination, act accordingly and look at sizing it appropriately, right? So I'm not saying this is for everyone. I'm saying this is something that is it requires your discretion and your better judgment. Okay, I guess we've transitioned to Q&A point already, Jim. And before I go into Q&A, I want to share with you this promo code that we are giving our customers. So if you apply code HEAT 2025, you will get 3 months of no management fees on your fresh funds that are invested. So you should deposit at least 2,000. So whatever you deposit more than 2,000, this promo code will apply. This promo code should be applied before the 30th of April. So while your having your rendang and your lemang, there's a good time to put it in. And when you ultimately deposit that amount above 2,000, then it will be within the validity period of this promo code. This applies only to your next deposit, i.e. fresh funds. So existing funds with us won't apply. This promo won't apply to them. And you should invest. This only applies also to investment portfolios only. So if you make a deposit into StashAway Simple or cash management portfolio, this won't apply. If you enact a intergoal transfer between, let's say, StashAway Simple and a Bitcoin portfolio or other of a portfolio, it also will not qualify. We're looking for fresh deposits from outside the StashAway ecosystem. If you are a new customer of StashAway, if you're an existing customer of StashAway, this does apply. And yes, so the terms and conditions right in front of you in relatively legible print. So do read that and take that on board. Okay, so going into Q&A, we've addressed some of these. Okay, so someone asked, you started with Bitcoin and Ethereum. What's your plan over the longer time frame to introduce new ETFs? Yes, Jim, any thoughts on new additions to our crypto offerings?
Yeah, so I think just like any other investment in our investment universe on our platform, we'll continue to monitor the developments in the ETF space. And if it fulfills sort of the requirements around liquidity and around cost, then we could potentially start to see sort of more introduction of new ETFs. But obviously, the ETFs that go into our platform undergoes a pretty rigorous screening just to make sure that whenever we're transacting, all the fees are reasonable. There's no meaningful slippage when we actually do the transactions, when we do the trades. But for sure, we'll continue to monitor the universe going forward.
Someone here, presumably a little bit more initiated in the ways of crypto, actually asked if our ETF units are staked, in the sense that if you stake these cryptocurrencies, you could get additional yield. I would say right now we don't offer those additional earnings to stake and get this extra earnings. That is because ETFs are not set up that way yet. It's not on chain per se, and it will stay as kind of dormant units, just as a holding.
Yeah, also just to add to that, I suspect, so if the question is also pertaining staking through the ETFs, my current understanding is that the ETF, the fund managers of these ETFs don't actually stake the coins that they hold. And I suspect that's also due to liquidity concerns, right? Because if you're BlackRock managing the ETF, the Ethereum ETF, for example, and all of a sudden you have a massive redemption coming in, you don't want your ETH to be locked into the staking pool where you can't pull it out. And so I suspect there is some consideration around liquidity from the fund provider side. But also, maybe I can just take this question to a slight tangent, because I also wonder if people over the past year have seen there's a pretty big price divergence between Bitcoin and Ethereum. So I think since 24 of Jan 24 until now, Bitcoin is up roughly 100%, whereas ETH is flattish to down 10%. And actually, I suspect that price differential comes back to the question around staking. And I think it's because Ethereum, through these ETFs, they don't stake the ETFs, so you don't actually get the additional pickup in the staking yield, which I think is a big sort of rationale for why you would hold ETH over Bitcoin. But as a result, you've actually seen that the AUM growth in Bitcoin versus Ethereum is much, much higher, right? So even with the Fidelity funds that are on the platform, we're talking about roughly 20 billion versus roughly 2 billion, right? So that's a difference of 10 times. And when the AUM size grows, obviously the fund providers have to buy into these coins. And so actually there's evidence that shows that as a result of like BlackRock and Fidelity and these other fund managers stepping into the space, they're actually the ones bidding up Bitcoin prices, which pushed up over 100K, right? And so I think that's kind of related to this question around staking and staking yields. I think that's also why you've seen a pretty big divergence in price action between Bitcoin and Ethereum over the past year and a half or so.
Yeah, I also quickly looked up what were the staking yields. I see from big crypto exchanges really looking at around 2 to 4%. To me, obviously every bit counts, but to me it's also incremental, right? Like if you think about the Bitcoin's 60% per annum gains over a long-term time period, I think this is only incremental. And yeah, it's nice to be efficient, but we'll see how this space evolves. I've also heard of staked ETH being offered as an ETF, but that's still still being under review by the SEC. So we'll see how it evolves. Right now, we are offering Bitcoin and Ethereum only, and no other coins as of this moment. So we'll see. From our point of view at StashAway, I think it's important to be right. We don't necessarily have to be first because we are introducing a new, we're introducing something very new. It's a new asset class, and we want to make sure it's battle tested. And we looked at this space very intently in 2021. Not saying that we shouldn't have done it back then, but we've all seen what happened afterwards, right? So, and obviously Bitcoin and Ethereum survived those things, but they were top 5, top 10 coins that now no longer exist, right? So if we were a little bit too early, got a bit overzealous in terms of what we choose to offer through ETFs or on-chain, we might get burnt ourselves as well. So
right. Also, maybe I could just add one more thing. I mean, this ties back to a question I was asked before, which is about like the MAS issuing a statement saying that consumers should stay away from cryptocurrencies. I think you made a good point before, which is that you really need to draw the distinction between cryptocurrencies, right? Because the whole universe of cryptocurrencies is very, very broad. And I feel like when people read about all of the sort of the pitfalls and all of the scams that are going on, that's sort of all in, a lot of that is in the meme space. Then there's exchanges as well that have been hacked. But I think broadly speaking, if you just stick with this quote unquote large cap cryptos like Bitcoin and ETH, it's much harder to go wrong. And in fact, you can make the argument that those profiles are very, very different from the meme coins that are out there, which very, very likely will go to zero, right? And I think that's sort of the area that I would very much stay away from. But from a portfolio diversification perspective, you can make a very strong argument for number one, why Bitcoin and ETH aren't going to be like these other meme coins, but second of all, why it actually has a legitimate part in terms of portfolio diversification and portfolio allocation.
Christine asks, does the Fidelity ETF only invest in Bitcoin, no other altcoins? So yeah, Christine, so these ETFs are specific only to Bitcoin and Ethereum, 2 separate ETFs altogether. No other coins or altcoins are included in this ETF. And that's exactly what we intended, right? I think what we wanted is a very clean segregation between different asset classes to begin with, and underlying all of that, no derivatives. So we didn't want forwards, right? We wanted only spot. And because of that, we understand what we hold in our portfolio. There's no surprises that could occur from asset classes acting in a very strange way and resulting in risks we do not foresee. So we only invest in spot ETFs with underlying real assets, whether it's tokens in this case, or whether it's stocks or bonds in other ETFs as well. There's a tax question. So from my understanding, capital gains is not taxed in Malaysia. And if you trade securities, then you're classified as a professional trader, upon which then your trading gains are assessed as income tax. So as long as you hold for more than a year, your holdings are not subjected to tax, right? So you're fine from that point of view. Someone asked as well, from our point of view, is Bitcoin and ETH securities or commodities? Why or why not? Very sophisticated question. I have a preliminary answer in my head, but Jim, do you want to take the first stab at this?
Yeah, I mean, my perspective here is that there's some technicalities. So I think technically, if you're talking about the Fidelity ETFs, that hold Bitcoin and ETH, those are technically securities. It's managed by the SEC in the US. If you're talking about the physical Bitcoin and ETH, it's probably closer to, or it's more akin to commodities. But I would actually argue that it's its own asset class. So it's actually neither securities nor commodities, but cryptocurrencies. But I think in terms of relevance, in terms of on the investment standpoint, I feel like it doesn't make a huge difference. I think, yeah, because I think ultimately what you want is just to have that exposure in your portfolio. If you decide that there's a space for cryptocurrencies in your portfolio, but I think the way that we've offered it through Flex makes it easy so that you can actually have that exposure very quickly through the platform.
Yeah. If the question's intent is something around the investment case, right? If you're worried that something might be classed as a security and therefore the SEC might come down on it from that angle, doesn't apply to these two because they've already been cleared, and these underlying assets are both not securities. So from the investment case point of view, doesn't really apply anymore to these two. And then that's why you saw why XRP did very well when the SEC announced that it's dropping its case against Ripple and that it's not classified as a security. Not a legal expert, but ultimately that's where they landed, and it was good for the price action of XRP, but doesn't apply to Bitcoin or Ethereum. There are other academic and interesting perspectives here, or why it matters if it's a commodity or not, but I would say that's a little bit too esoteric for this conversation. So maybe if you read up on or learn from Michael Saylor why he thinks it's a commodity and why that's a good thing, maybe that would help your point of view. So we're nearing 1 o'clock. I think we've also answered all the questions, and I hope that you've learned a thing or two. Yeah, I think we've cleared all the questions. I hope you learned a thing or two from today. Jim, maybe do you have any takeaways for our audience before we head off for lunch?
Yeah, I think the biggest takeaway I hope everyone can get from our conversation today is just to really consider where and if crypto has a space in your portfolio. I think there's a very strong argument you can make just to add a tiny bit of allocation to Bitcoin or Ethereum, or even both, but just be mindful that you size it appropriately based on your risk tolerance. And ultimately, if you do to make that decision, I think over time, your portfolio will be much more manageable in terms of volatility, and also you'll see a nice pickup in returns as well.
Good. My key takeaway is that there is a promo code. So apply ETH 2025 if you're looking at making investment of more than 2,000. It doesn't apply to just the crypto ETFs. Feel free to invest in anything related to this. And of course, to my Malay friends, Selamat Hari Raya, and to everyone else, happy holidays. Thank you very much for joining us here today. We had really good conversation. I thought anyway. And have well, my point being, we can do more of this. So if we see more interest in our crypto portfolios, and if you want us to cover the latest news and developments regarding Bitcoin and Ethereum, do let us know, and we can certainly do another webinar down the road. But Jim, thanks so much, and I hope to catch up with you when you're in KL. And in the meantime, see you around.
All right, thank you everyone for your time.
Bye, everyone.